Hi and welcome back, traders. Today we have a special episode where I will give you the usual technical analysis along with some real economic and fundamental investigation to uncover the truth about the biggest market participants, central banks. Now, these guys had so much effect on the market, and I will explain how and why they pushed up the price of gold last year and what will be their next big move this year. And finally, I will introduce you to the number one financial indicator which you should be looking at when you're planning your long-term strategy on gold. So if you're interested to get some real finance knowledge, then make sure you watch the following minutes carefully. So let's start by looking at the technical analysis and the recap on what happened with gold this week. So around the 16th of February or midweek, I posted an explanation video about this wedge which appeared on the market and how I was able to catch two short trades all the way down to the 1770 area. So we already in profit for the whole month, but adding these two additional profitable trades to the P&L, it's an excellent result. So as soon as the price stepped into the 1770 area, we see some kind of support formed and the price broke through this descending trend line. So I posted in the public and the private Telegram chat that we may expect some bounce back from the 1770 area, so I entered into two long trades, which was a good setup as we had 3 to 4 confirmations. But the next day when I woke up, I noticed that the price had other ideas, so invalidated both of the trades and I got stopped out. Because the price came back and retested the 1760 area, which is a strong number, and also have other confirmations on the weekly chart why it was bounced back. So despite having these two losing trades, if you look at the P&L on the top left corner, you can see that we're still in profit for the whole month and the week, even with these two trades. And my bias was that the price will come back to retest the 1800 area, so I entered into another two long trades as soon as the price started to form a market structure by creating a higher low. So if you draw the trend line from swing low to swing high and look at the line chart, you can see that the price is creating higher lows and higher highs. So we can expect this week the price to continue to form this kind of market structure by creating higher highs and higher lows. So the price, if you found support on this level, to create a new higher high, come back, create a new higher low, and continue this trend all the way to the 1800 area. Now, if the price respects our trend line and the market structure, you have a good chance to catch a few hundred pips all the way to the 1800 area. But be warned, if the price comes back to 1800 or 1815, we can expect some sharp reversals to the downside. Because in the members area, I posted some fundamental and technical analysis and explanations on why I expect the price to reverse to the downside. So if you're interested into joining the members group, make sure you check out my website at alphafx.hu, and you can find all the information and my contact Telegram button. So going back to the chart, we talked about what to expect this week. So if the price continues to make higher highs and higher lows and respecting the trend line and forming a bullish market structure, then you can catch a few hundred pips all the way up to 1800. Now I have two levels marked, so the 1820 and the 1840, because we have two different confirmations on both levels. But if you look left, you can see that there's definitely interest on 1845 as well as on 1820 and 1800 areas. So we don't know exactly what's going to happen, but what I'm really 100% sure is that the price will respect or will reject these one of these levels, and it will make its way to the downside, and it will fall hard and sharp. So going on a higher time frame, we can see that the price since the $2075 area, it's creating lower highs and lower lows, and it didn't break the bearish market structure and keep retesting the previous all-time high from 2012, which so far holds strong. But there are other fundamental elements of the market, and some other market participants enter the market. So I expect the price maybe to hold the 1760 area for a couple of weeks, but from March onwards I expect some more bigger and sharper drops to the downside, and price could go down all the way to the 1500 area. So let's go now to the fundamentals, and let me show you why I think that the price will fall to the 1500 area. In the past couple of weeks, we talked about two possible scenarios, going long and going short on gold. Right now, it's hard to tell which direction we're heading because there are so many higher powers who entered the gold market in the past years, and we don't know their exact intentions just yet. But let me show you what's happening in the higher circles of an elite club, the central banks. So last year we saw a tremendous increase in gold price, surpassing the previous high in 2012, making a new all-time high in 2020. But do you know what was the core reason behind this rally? Yes, you guessed it right, it was the central banks. But why are they racking up so much gold? Why are they purchasing so much, and what are they preparing for? So looking at some publicly available central bank statistics, we can see that this chart represents the significant central bank holders or reserves of gold bullions all the way from 2000 to 2020 third quarter. This data was compiled by the IMF using the International Financial Statistics, which tracks the central bank's reported purchases and sales of gold bullions. Now this is physical gold, not the paper market. And for this example I chose three countries, the Russian Federation, Turkey and Venezuela. If you scroll down you can choose any countries you want, but let's start and focus on these countries at first. So you can see that since 2017, those countries who had heavy sanctions imposed by the US or any European countries, and also if they had any distress or political turmoil within their homeland, you can see that they started racking up some heavy amounts of gold. For example, Turkey quadrupled their gold reserves since 2017. Venezuela increased their gold reserve by 70%. And if you choose any other countries from this list, for example Italy or any more stable countries which doesn't have as much geopolitical tensions, and these three examples, they might not increase their gold reserves this dramatically, but they did increase to some point. So my point is that doesn't matter which country you choose, even Austria, which is a strong country and stable, you will see that every single country from this list increased their gold reserves in the past couple of years. If you look at the COMEX delivery data from the futures markets, so it's the commodity exchange in London and New York, Chicago. So while millions of ounces of gold traded on futures market every day, typically only a tiny fraction of that goes to delivery. But in recent months and quarters, huge amount of bullion have flowed into New York and the COMEX, and we can see record deliveries of physical gold, which confirms our previous chart that the central banks are not just buying gold, but they're buying actual physical gold and stacking up on reserves. And also there was another interesting article in the Financial Times where one of the authors talked about that these countries are not holding the physical gold in foreign countries, for example the central bank or Switzerland. They're actually repatriating these gold bullions into their own homeland, so they're delivering this massive amount of physical gold back to their own country. And I could think of two reasons for this. The first one is obviously political reasons. See, if you look at another data, you can see on the chart that Russia has started to shrink the stockpile of US treasuries, meaning that they're selling all the US treasury bonds or the government bonds which they held in their reserves. So on one hand they're increasing the physical assets of gold, and on the other hand they reducing the exposure to the US treasuries. And one of the reasons for this, and also in other sanctioned countries and less stable countries, is because they start to devein from themselves from the US treasury addiction. So previously these countries bought and purchased US treasuries in US dollar because that was the number one safe haven asset. So the US government will not fail because they are so indebted, and these countries had so much exposure, and because they were sanctioned, they're trying to first fight back, and the second one is trying to de-link their economy as much as possible from the US economy. The other reason why central banks around the world hoarding up huge amount of gold reserves is due to the upcoming regulatory changes in the financial sector. The Bank of International Settlements is considered as the godfather of all central banks. So any recommendation which comes out from the BIS, the banks and central banks around the world religiously follow these recommendations. And the BIS came out with the Basel recommendations, telling banks how much capital reserves they should hold in order to survive, or should be able to survive, a financial crisis. So under Basel II, gold was classified in the third tier of the capital reserve requirements and treated as a risky and illiquid asset. This means that the gold reserves on financial institutions' balance sheet were subject to a haircut of 50%. So it simply means banks were only able to consider gold in their books with a 50% reduction of its real market value. Now under Basel III, these rules are changing, and every central bank will be able to revalue its physical reserves higher from a current 50% haircut into a fully cash exchangeable asset. So moving gold from tier 3 to tier 1, in accounting terms, gold will become a more liquid asset. So therefore, the 50% revaluation means that the central banks will be able to pay off massive amounts of debt. And on top of that, the significant financial institutions are now required to quadruple their reserves compared to the minimum requirements established in Basel II. But it doesn't mean they have to boost their reserves with gold. So it strikes the question: will central banks in sanctioned or heavily indebted countries will dump their revalued gold to pay off their debts? It's quite possible, but this is only a speculation. But if this happens, and you saw the charts previously that central banks around the world racked up huge amount of gold, and if they dump that gold on the market, then the price will break below the 1700 area, and it could easily reach the 15 or 1400s. And we arrive to the most important chart of this whole video, which represents the gold spot price by the yellow line and the US Treasury yield spread by the white line. The Treasury yield spread is made up of two numbers. The first one is the US 2-year Treasury yield, and the second one is the 10-year. Adding these two numbers together, you get the most important financial indicator in the whole world, which is the Treasury yield spread, which represents the inflation expectation, the short and the long term. So the 2-year is the short term, the 10-year is the long term. And every single finance professional and trader and capital market participants, they watching this indicator closely. And you can see immediately on the chart that there's an inverse correlation between the gold price and the US Treasury yield spread. And currently the Treasury yield spread is steepening, which means it's going up. And for a few simple reasons. The first one is because the inflation expectation has started to increase. And to simply explain, the US Treasury market, which represents the public sector, and the stock market, which represents the private sector, are always in fight with each other, because imagine the government, the US government as a business. They have to make money. And how do they make money? By selling bonds, US treasuries. Now, in the recent years, since the great financial crisis, the average yield, or the overall yield, was under historical lows around 0.3% or 1%. The simple reason for this is because they wanted to boost the economy, they wanted to boost the stock market. So what they did is they reduced the yields on the bonds, they flooded the market with treasury bonds. So if the supply goes up, the price goes down, and this is a natural or simple economics. So the stock market had a good 10 years of bull run, because we're hitting all-time highs. But now it's time to change, because the government just lost huge amount, trillions. Every single government around the world lost trillions of dollars fighting this coronavirus and the pandemic. And now it's their turn to make back some money. And what they do is, because they have to compete with the private sector, with the US stocks, they have to offer something to the investors. And what they can offer is yield on the bonds. So as soon as they start to increase the yields on the bonds, the demand from the stock market and all the other assets will shift to the US treasuries, because that's one of the safest assets in the whole world. It's even more safer than gold or anything. So by increasing the yield, they're offering a higher return on the investment of the investors, and it's safer than anything else, much safer than the stock market. So what will happen in the next few months if this treasury yield going to steepen and the yields are going up on the treasury bonds? All the money from the stock market and other assets will flow into the US public sector because investors will start to buy bonds. So this is a really scary outlook for the gold markets. And so we painted up, or we discussed 3 scenarios and 3 reasons why and what happened with gold. The first one, if you remember, was explaining why central banks around the world racking up huge amounts of gold reserves and some of the central banks increased their reserves by 70%. And the second chart we talked about was the regulatory changes in the financial markets. So Basel III comes into effect this year, March, which means that the central banks will be able to revalue of their physical gold reserves at a 50% higher price. And what they might do is they might dump this gold on the market as soon as they can revalue at 50% plus to pay off their huge amount of debts, which caused by not just the coronavirus, but the sanctions and the past 10 years since the financial crisis. And the third one, this chart, which represents the US Treasury yield spread, we can see that the inflation expectation of capital markets are increasing, and if inflation goes up, that will affect everything because the money will pour into the US public sector, investors buying government bonds, and it has to come out from somewhere. And naturally, the money is in the stock markets and all the other assets, so you will see a rebalancing of the portfolios, pulling out money from the stock market and pouring into the US public sector. So guys, this was the video analysis about the gold, and the conclusion is that if we break the 700 level, we can see hundreds of dollars drop to the downside all the way to 1400. So because we don't know what's going to happen yet with the central banks holding of reserves, but once they move, the price will move big. So stay safe, and I hope you enjoyed the video. Make sure you hit the like button and the subscribe button, and see you next week.